The United States Export-Import Bank has been around since the 1930s, but it has never faced the difficulties that it faced this year in getting reauthorization. This is Steve Wiseman at the Peterson Institute for International Economics with Fred Bergsten, Director Emeritus and founder of the Peterson Institute, to talk about why the Export-Import Bank, what it is first of all, and why it's facing so many difficulties this year. Fred, thanks. First, tell us, what is the Export-Import Bank and why is it so important?
The Export-Import Bank is a government corporation. It functions as a company owned by the government. Its mission is to help finance U.S. exports. There's a market failure, as economists call it. Private banks do not provide enough finance to expand our exports around the world as they need to be expanded to create jobs and production here in the U.S. and to compete with other countries. So the U.S. has a government institution, the Export-Import Bank, that provides credits that the private market won't provide. It does longer maturities than the private banks would offer. Its interest rates are sometimes a little bit lower, but it still makes money. It's not a drain on the taxpayer. It, in fact, returns a profit to the Treasury every year. So some of this debate over its existence is, frankly, not very well founded.
So why did the opposition emerge this year?
I think the opposition to the Ex-Im Bank now is a reflection of the broader efforts on one wing of the Republican Party to reduce the role of government. They see it as a government corporation that they don't think is necessary. They view it as supporting big U.S. companies, in fact, a small number of big U.S. companies that are big exporters. And so they sometimes characterize it as corporate welfare. So you put together the fact that they don't like government in the first place, that they particularly don't like government helping big companies, and you find the motivation for eliminating an institution that has proven its worth over the last 80 years.
And of course, other countries that are major exporters have something similar. In fact, some of their export financing efforts are even bigger than the United States. Is that right?
The major point in this whole debate is that every other important trading country has an export credit institution of its own. As you say, most of them are much bigger than ours. Most of them subsidize their export credits much more aggressively than ours. In fact, U.S. exporters are at a competitive disadvantage even with the existence of the Export-Import Bank because it does not compete as fiercely as the others do. If we were to get rid of the Export-Import Bank in this kind of world, it would amount to unilateral disarmament. It would mean that we were denuding our exporters of at least the semblance of competitive export finance vis-a-vis their main competitors. Many of them would then just start servicing their international markets from other countries. If we literally eliminated the Export-Import Bank or even cut back on it significantly, our multinational firms who have plants and subsidiaries all around the world would simply start selling to China or India from their French or German or Japanese subsidiaries. The U.S. would lose jobs and employment. It would be crazy.
A lot of people have changed their position. I mean, President Obama was an early skeptic of the Export-Import Bank. What's changed his mind and put it in the context of the Obama administration's trade strategy overall?
Right. Well, President Obama did not recognize before he came into office how important trade was to the U.S. economy. We export $3 trillion worth a year. It's a huge creator of jobs and employment in the U.S. economy. So the president, after having come into office with not too much enthusiasm about trade, has paradoxically launched the most aggressive trade negotiating agenda in the history of the United States. He's trying to negotiate a whole new trans-Pacific free trade agreement. He's trying to negotiate a transatlantic free trade agreement. He's got half a dozen negotiations going on in the World Trade Organization. He pledged to double U.S. exports over a 5-year period coming out of the Great Recession. So trade has become a central element of the administration's whole economic strategy and part of its foreign policy strategy. As part of that, you have to enable your trading companies, your exporters, the companies and the workers, very notably, to compete on a level playing field. And the whole objective of the Export-Import Bank is to provide a level playing field for American firms and workers in the export credit space in comparison with their competitors all around the world, both the traditional competitors in Europe, Canada, Japan, but now notably with the emerging markets, China, Korea, the other big emerging trade competitors of the United States. They are particularly aggressive in this area of export finance, and that's why we have to both compete with them and try to get them into a new negotiation that would put some self-enforced limits on the degree of subsidization that goes into these export credit programs.
Right, let's just wind up with that. I mean, you made an interesting proposal in the Washington Post recently that addressed the concern among some in Congress about this being corporate welfare. Explain what you proposed.
The ideal world of export credit would be one in which each of the countries filled the gap left by the failure of private banks to finance exports, but did not subsidize, did not provide below market interest rates, for example, that would amount to a subsidy in traditional economic terms. The problem for the U.S. in doing that on its own, let alone eliminating the bank, would be it would disadvantage our exporters against those of other countries. So the strategy that I actually implemented when I was in charge of this policy back a long time ago in the Carter administration was to fight fire with fire. Have an aggressive export finance program of our own to show the others we meant business and would not let them get away with undercutting us, but then go to them and say, we should all negotiate a ceasefire. We should all...
Or at least an arms reduction. Right?
Well, at least some self-limitations
right.
on the extent to which we are willing to finance our exporters. Let's live by a common set of rules, notify each other what we're doing, so if anybody gets out of line, others can match. That's a very effective deterrent then to keep the thing working. We actually did that in the late 1970s and 1980s. It worked like a charm. An international agreement was reached that still exists, but now it's got a lot of holes in it. It needs to be updated and reinforced. But that two-track strategy, I think, is what's needed. Far from eliminating the bank, we need to actually expand its firepower, what it can do, use then that renewed U.S. credibility to negotiate a ceasefire with the new countries, particularly the Chinas and Koreas, and try to restore order in this world of export credits, which we had for 2 or 3 decades, but which now has eroded again.
Right, so the art of economic diplomacy. Thank you very much, Fred, and thank you.